Good afternoon, everyone. It's Monday, the 9th of September, and welcome to another edition of Monday Market Picks. My name is Tilan Wickramasinghe. I'm the head of research for Maybank Securities here in Singapore. So thank you so much for joining us. Now, there is about a 35% chance that the Fed will do a jumbo cut in another 2 weeks of 50 basis points. There is some slack in the US economic numbers, but particularly on the employment side. And this actually could be a boon to a lot of ASEAN dividend stocks, which have actually been battered over the last 2 years or so. So we're going to take a little bit of a closer look on some of these stocks today in the show. A lot of this is much evident in the SREITS sector. A lot of stocks have been battered down. But the recent CICT deal where they're buying part of Ion Orchard, is this a sign of spring? We've got Krishna joining us to explain. SINGTEL has had a pretty strong performance over the last few months. And Hussaini has just come back from their corporate day recently, and he's come back a lot more bullish. So we're going to have him to discuss why that is. And then moving across the causeway, Desmond Ching is sticking to his guns on a very positive call on the Malaysian banks. And let's find out what he's thinking after the second quarter results. And then finally, Jarek is back from the US, where he visited a lot of CSC's plants, and he's actually come back a lot more bullish as well. So we're going to have him talk about why that is as well. So now let's start off. But before we start off, actually, I just want to give a quick shout out to our Telegram channel, which has a lot of information that comes out on a daily basis on some of our key research picks. You can actually sign up for that by scanning the QR code here. You'll also get a recording of this show as well after the show is done. So I think it's very essential investment reading. So do join our Telegram channel if you haven't done so. Now let's get to Krishna. Krishna, welcome to the show. CICT announced a 50% stake acquisition of Ion Orchard. Can you give us a bit of details on what this transaction entailed?
Sure. Thank you, Tilan, for having me. So probably the asset doesn't need any introduction to our client base here. They would already have done some shopping, hopefully, there and seen the large crowd out there. So jumping straight to the deal details itself, CICT is buying a 50% stake in the asset for about $1.85 billion Sing dollars. This equates to about quite healthy 7.1% gross yield. This is in line with the malls along the Orchard Road and then some of the other destination malls in Singapore. The deal will be funded fully by equity. They have raised about 1/3 of the amount, and the remaining 2/3 will be raised by an underwritten rights issue in about a month. On a pro forma basis, the deal is accretive, about 1%, and the NAV and gearing are relatively unchanged. So net, you are getting some DPU accretion without much increase in the overall gearing.
Right. So is this the sign of spring that we've been waiting for the REITs? I mean, we're starting to see, is this like the first of transaction volumes coming back? What do you think?
Yeah, so I think that's a great question. So definitely, I think this sector is always impacted by the macro variables. So, the economic growth and the interest rate outlook impacts the sector in a lot more bigger way. So if we do get a sustained rate cuts without sacrificing economic growth, that will definitely be helpful to the sector. But we should keep in mind that this rate cuts, the sentiment is definitely positive for the sentiment, but then the counters can run ahead in anticipation of this rate cuts. We just need to balance both of those.
Got it. I saw you had actually mentioned that a 50 basis point reduction in sector discount rates can actually result in about a 10% jump in target prices. So keeping that in mind, and I also got a question from the audience here from John Tan, who's asking what are the best options among the REITs for dividends. What are some of your top picks for investors right now?
Yeah, so within the the index names, we are having CICT, CLAR, and Maple Tree Logistics Trust. And then on the small and mid cap space, we are having Far East Hospitality Trust, Lendlease Global Commercial REIT, as well as OUV Commercial REIT. So it gives a good balance across the various subsectors. And then you also have spread between the relatively tighter yield as well as the 7 to 8% kind of an yield, which will hopefully get compressed if we get those conditions of a sustained rate cuts without sacrificing any economic growth.
Got it. You can see a lot of top picks on the screen right now as well. So thank you, Krishna, for joining in.
Thank you very much.
Let's get Hussaini on screen right now. Hussaini joined SINGTEL's Corporate Day, which are special days that the company organizes for investors as well as analysts to deep dive into the different aspects of their business. And he actually came away quite positive from this SINGTEL Corporate Day. Hussaini, why did you come back so positive? Any key highlights that you like to share with us now?
Sure, Thilan. Thanks for having me. So 3 areas where I came out with a more positive view on SINGTEL. First is obviously dividends. Now, management committed to its dividend guidance of 70 to 90% of regular dividends or regular dividend payout, and 3 to 6 cents in value realization dividend, or we can call it special dividends. So if we see company's balance sheet position, cash flow generation, and top debt with an additional 6 billion Sing dollars in capital recycling or capital raising, company can comfortably pay at the higher end of its dividend guidance, and that translate into an attractive 6% dividend yield. So I think this is one of the best operational yield in Singapore, 6%, especially once the interest rate cycle turns. So that's the first key takeaway. The second positive takeaway is Bharti Airtel in India. So Bharti management is aiming for India ARPU to increase from 211 rupees right now to around 300 rupees in the medium term. And if we see Bharti is also firing on other cylinders as well, which includes data center, enterprise services, as well as fixed broadband. Okay, so Bharti remains in a very strong position. And the third positive takeaway was SINGTEL's data center and cloud business. Now, therein, as far as data center goes, company is looking to increase capacities by 4 times and EBITDA by 2 times in the next 3 to 4 years. AI-related use cases and GPU as a service are other key areas of growth for as far as SINGTEL is or the data center and AI business is concerned. SINGTEL is a very big group, so there are a couple of headwinds as well, such as Telkomsel and Optus penalties. However, I think tailwinds far outweighs the headwinds. So to sum it up, SINGTEL is in a solid position operationally and can potentially pay at the higher end of its dividend guidance, translating to an attractive 6% dividend yield.
Got it. That's great, Hussaini. Thank you for that update. A lot of positive momentum behind SINGTEL right now. And for our Thai audience who are watching, you can get direct exposure to SINGTEL from the SINGTEL deposit receipt that is available on the SCT as well. Thanks, Hussaini, for joining us. Now, let's turn to the Malaysian banks, which have just completed their first half results reporting. We've got Desmond Ching in online to discuss the Malaysian banks and take us through the results. Desmond, welcome to the show. What are some of the key highlights from the results season, and anything that surprised you?
Yeah, hi, Tilan. Afternoon. So essentially, the second quarter results were quite encouraging in that most banks actually reported results that were within expectations. And looking at the trends that we saw during the quarter itself, loan growth momentum was still pretty intact in that for the banks within our coverage, aggregate loans growth was about 7%, including overseas loans. In the case of the banking industry itself, it grew by 6.4% as at the end of June 2024 for the domestic industry per se. What we also saw is that margins expanded Q on Q, and overall, this was moderated by slower non-interest income to some extent, but this was because the first quarter of this year was a pretty robust quarter for non-interest income. So the moderation was actually kind of expected. Expense growth was still a little bit strong, so operating profit as a whole was relatively flat. But again, credit costs were stable and associate contributions improved. So pre-tax profit actually grew by about 4% year on year during the quarter itself. Sorry, in the quarter itself, it grew by 8% year on year. And for recurring net profit, it grew 9% year on year.
Okay, so pretty punchy numbers there. Now, you're keeping your positive call on the sector now, despite the fact that we're expecting some rate cuts coming ahead. Typically, banks tend to underperform during rate cuts. So what's driving you to keep your positive call here, Desmond?
Yeah, so if you take a look at the interest rate direction per se, although we do expect interest rate cuts in the US, but we expect Bank Negara to keep the overnight policy rate stable. So currently the OPR is around 3%, whereas the Fed fund rate is about 5.25 to 5.5%. So there is a huge gap of about 250 basis points between the two, simply because Bank Negara actually paused its rate hikes way ahead of the US. So what we opine now is that as the US cuts its interest rates, there is no reason for Bank Negara to cut its interest rates anytime soon. And so the gap should actually narrow over time. That Bank Negara keeps the OPR stable is actually good for Malaysian banks because it means that our NIM should be more stable than that of its neighboring countries. Also, if we take a look at where we're expecting earnings to fall this year, we're looking at aggregate operating profit growth of about 7.6% for 2024. This is premised on domestic loan growth of about 5 to 6%. We're looking at stable NIMs. We're looking at stable non-interest income and cost-to-income ratios as well. And in the face of lower credit costs, we're projecting higher net profit growth of about 8% year on year and ROEs of about 10.4%. This momentum we think will carry into 2025, where we're looking at profit growth of about 6% and ROEs of about 10.5% for the industry. So generally, coupled with the fact that evaluations are pretty decent still for the banks, despite the recent run-up, and the expectations that foreign inflows will accelerate once the Malaysian ringgit continues to strengthen against the US dollar amidst more stable interest rates, then this should be overall positive for the banking sector.
Got it. So appreciating currency, stable margins, strong credit growth, all providing that backing for the Malaysian banks. Now, taking from that context, Desmond, what are your top picks?
So at this point in time, the top picks in order of preference would be AMMB, CIMB, Public Bank, and RHB being the top 4 picks. We have also got a buy on Hong Leong Bank and Hong Leong Financial Group.
Got it. Thanks so much, Desmond, for joining the show. A much more detailed note is available on our newsletter today. Now, with that, let's turn to our attention to one of our high conviction opportunity plus stocks, CSE, And Jarik's just back from the US, visiting some of CSE's operations there. So Jarik, let's kick off by telling us, what plants did you see in the US?
Hi, Dylan. Yeah, sure. So I went to the Houston plants in the US. So basically, the Houston plants are mainly for the electrification business in the US. So basically, it accounts for close to about half of CSE's revenue. So they have two segments. One is the electrification, and the other one is the wireless communication. So I went to see the electrification factories in the US for CSE.
Okay. So what were some of the key takeaways that you had from these visits?
Well, I think the key takeaway is like the bullishness in terms of the ground feeling is on par with what I saw with Dynamic last year when I went to see their yard. So the whole factory, the factories that we went to, it was all almost fully utilized. Capacity is seen to be lacking in the sense that they needed to expand more. So I think that every factory that we went to about 3 or 4 of them. All of these factories are showing that basically utilization is close to about 80 to 100%. They needed to expand for more going forward as well from the demands for their customer, especially on the data center front. And we also went to see what they actually do on the ground so that now we come back with better understanding on why certain things like data centers and all, they need more space. Capacity has been expanding at what kind of rate in the last 3 or 4 years. Revenue has been expanding also at what kind of rate for the last 3 or 4 years, and why do they actually need much more capacity going forward, and what are their plans, to actually get all this capacity going in the next few years. I think all this has been quite bullish for us or for what we see on the ground.
Got it. So, so does this add to your conviction on the stock?
Yeah, so surprisingly, I mean, when we came, before we went, we were already quite convicted that, this whole electrification team in US is doing very well. But when we went there and we see for our own eyes, we got even more convicted, which adds to our conviction. So basically, just on the data center front, they have about 40,000 square feet of space. They have secured another 35,000 square feet of space already. And that is only fulfilling demand from that one customer in the US data center space for 2025. So for 2026, they will actually need to expand further or at least double of that 25,000 capacity for the orders that they are likely going to get in 2026 for just that one customer. And for the rest of the plants, for the oil and gas side, LNG, they're also seeing good growth coming from that area. They're also seeing a lot coming from EV charging, public utilities like your power distribution centers, your water treatment centers, because apparently now there's a lot of migration going around the US where the more expensive cities are seeing migration out of those cities and moving to cheaper cities like Texas, Houston, and the other surrounding cities that are much cheaper. So the government is actually pumping a lot of infrastructure projects to upgrade all these grids and so on for this migration of personnel as well. So I guess, if you look at their current space, they actually expanded from about 100,000 plus square feet 4 to 5 years ago to currently close to about 400,000 of square feet space for its factories. And we do think that going forward, they will need to secure at least about 600,000 square feet of space by 2026 in order to meet customers' demands and also their pipeline of projects. Yeah.
Got it. Thanks, Eric. We put a buy on this stock at about 40% upside. So do take a look at Opportunity Plus stock CSE. With that, let's quickly turn to our technical trading ideas. We've got WINGT Holdings as a technical buy from our chart guy. And then we also have YANGZIJIANG Shipbuilding, a stock that's done pretty well. Our technical chart guy is now flagging this as a technical sell. So do read our newsletter for more information on that. Now let's move on to upcoming events and dates. We've got quite a few events coming up this week. Unemployment rate for Singapore out on the 13th. We've got the all-important FOMC meeting on the 18th. We've got Singapore's export numbers as well coming out on the 18th as well. The PMI numbers coming out early October on the 2nd of October. So you can get a lot more of the calendar on the newsletter as well. In terms of events that we are hosting, quite a few things coming up. We've got Maybank and Bloomberg co-hosting an Invest Vietnam virtual webinar. If you'd like to take part in this, do speak to your salesperson. And also, we have a great special invite-only event on the 25th of September, which is with the management of StarHub. We'll have a live event with the CEO, who will be the key speaker. So don't miss out on this on the 25th of September, and do speak to your salesperson to join this. With that, we are out of time. So thank you once again for joining us this afternoon, and thank you so much, as always, for your support, and have a profitable trading week ahead. Thank you.